Hello, everyone. Thank you for joining us for today's webinar, Navigating Tax Reform for Manufacturing and Distribution Companies in Minnesota. My name is Samantha Metcalf, and I am the Managing Principal of our firm-wide manufacturing and distribution practice within Clifton Larson Allen and live and practice in Minnesota. I would like to take a moment to thank the Minnesota Chamber of Commerce and Manufacturing Coalition for organizing an event around this very important topic. They have been very active in understanding the impact of tax reform from an individual and corporate level. Before we get started, I'd like to cover a few housekeeping items. Please make sure your phone line is muted. If you experience technical difficulties, please dial 1-877-582-7011. If you have questions on today's content, we have a planned session for Q&A at the end of the presentation. Your questions can be submitted at any time throughout the presentation using the Q&A box found on your screen. Links to the slides and webinar recording will be emailed to you next week. If you didn't hear about the webinar from CLA or you're not already on our mailing list, you can receive invitations to future webinars by subscribing to our industry-specific distribution list at claconnect.com/subscribe. And finally, we invite you to fill out the evaluations that will pop up when we end today's session. For those of you who may not be familiar with us, CLA is among the nation's leading professional service firms with an unprecedented emphasis on serving privately held businesses and their owners, as well as nonprofits and government entities. We promise to know and help our clients through having a deep understanding of the industries we serve. Our manufacturing and distribution team serves over 7,000 privately held manufacturing and distribution companies across the country. Our industry approach focuses on improving profitability, reducing risk, building sustainable value, and creating a legacy for the business and family members. Without further delay, let's introduce our presenters. Virginia, a principal with CLA, has more than 25 years of experience in the Minneapolis Manufacturing and Distribution Group and focuses on tax compliance, and tax planning for privately held businesses and their owners. Virginia also leads CLA's firm-wide Women in Manufacturing team. Finally, Virginia serves as an adjunct professor for the University of Minnesota's graduate tax program. Dan Kidney is a director at CLA and brings more than 17 years of experience in state and local tax. He works extensively with multi-state tax planning, compliance, and controversy issues, and leads CLA's state and local tax groups' income franchise tax practice. Virginia and Dan will be presenting tax reform at a very high level. You may have specific questions about how it affects you and your business. Please feel free again to submit your questions throughout the webinar or within the post-event evaluation. Any questions not answered will be followed up appropriately by a CLA professional. For those of you participating at viewing locations, we will have 30 minutes after the webinar for you to have a one-on-one discussion with our tax professionals. And now on to tax reform. Virginia and Dan, take it away.
Thank you, Sam. Our focus this morning is going to be an overview of the federal tax changes that were signed into law by President Trump on December 22nd, the changes that impact business federally, as well as an update from Dan on the Minnesota impact from these federal changes. We're going to start with the business impacts. We're going to speak very briefly on the wide sweeping international tax impacts. And if time, we're going to touch briefly on changes that impact the personal returns of the business shareholders and owners. Most of the federal tax law changes impact 2018 and future years. Many of the changes are scheduled to end in 2025, which is a function of trying to keep the federal deficit within required parameters. For the most part, it really is business as usual when you're filing your 17 business and personal tax returns. However, there are some decisions you can consider when filing your 17 returns that will impact 2018 and the future. So as we dive into the specifics in the 1 hour that we have today, we encourage you to listen with an open mind for those items that definitely do, and perhaps more importantly, for those items that possibly could impact your business. And even if you find that tax would be extremely boring to talk about for an hour, 2018 is definitely the year to be in conversation with your tax advisor in figuring out ways that you and your business can best take advantage of the new law, and perhaps more importantly, to avoid pitfalls and surprises from elements in the law that will increase your tax, or at least increase and change the cash flow related to making those tax payments. The new law is a blend of a multitude of items that decrease as well as increase your tax obligations, and the goal in planning is to figure out where you can take best advantage of the new law for a net reduction in your tax. And another very important goal for our 1 hour conversation today is to talk about how your Minnesota taxes will be impacted, so that you can use your influence through your legislators, through the Minnesota Chamber of Commerce, through other avenues in your own network to be part of shaping the Minnesota tax results. So let's dive in. The federal tax reform bill that President Trump signed on December 22nd is known as the Tax Cuts and Jobs Act, and that's the common name. And as you can see, it has a much longer official name. A couple of the primary goals of the new bill were simplification and tax reductions. Tax reductions, obviously, so that businesses and individuals in the U.S. can successfully compete in our global economy. And I think we'd all say that tax reduction was certainly achieved. C Corps have, especially those with significant international presence, certainly came out the big winners with rate reductions in the C Corp world from 35% down to 21% starting January 1st of 18. Even lower rates on the repatriation of foreign earnings, and then a future 100% exclusion of foreign subsidiary earnings through the dividend received deduction. But no matter which side of the fence you stand on, I think we would all agree that the approximate 493-page tax bill that was hastily finished and signed into law is anything but simple. In fact, there are important aspects of the bill that we still need significant clarification, technical correction, regulations to be able to fully understand and apply the impact. So with that said, on the federal side, Dan, would you update us a little bit on what we can expect from Minnesota?
Be glad to. Thank you, Virginia. Everyone, thank you for attending this morning. So for those who are attending, you might wonder, why would a federal tax bill affect Minnesota taxes or any state taxes at all? So before I dive into what the implications are, I wanted to provide some context around what that linkage is and why it would have an effect on state taxes. There is a concept called federal conformity that most states use, and all that means is when they have an income tax, whether it's a business tax or individual tax, when they're faced with the idea of how do we want to design this tax, they could either make something up from scratch, which maybe no one has ever heard of, and it's complex and you have to learn a completely new regime, or you could start with something that everyone knows, and there's a large body of law, people spend time preparing their returns, which would be federal taxable income. And so that's what a very large number of states have done, including Minnesota. When they have an income tax, business or individual, the starting point for computing that tax is federal base. Whether it's taxable income, whether it's adjusted gross income, it starts with the federal amount. So of course, if the federal calculation of that income changes, you might expect the state amounts to change. And so what has happened, very broad brush from a federal standpoint, is that Congress has broadened the base, they've lowered the rate, and they've increased credits. So the net impact of that, if you put all those together, is a tax reduction. What states conform to, whenever you hear about federal conformity, is they conform to the base only. They don't conform to rates, they don't conform to credits. So as you will see on the rest of the slide, Minnesota, they follow taxable income for businesses and individuals. You can do the entire slide. And if Minnesota conformed to the entire tax bill that was just enacted, for the reasons that we just talked about, they conform to the base, which just went up, but they don't necessarily conform to the rates or credits. Taxes go up a lot in Minnesota, and as you can see here, the Department of Revenue put out an estimate early January at the link that's on the screen that you can visit that raises taxes by almost $1 billion a year. That's a pretty significant amount, catches people's attention. There's some more discussion on this slide as to why that happens. The short version is the legislature meets later on this month, on February 20th, and it is only at that time that they start deciding, do they want to follow everything that was just enacted federally? The reason why we're in that position is that there are two types of states with respect to their conformity to federal taxable income. There are some that are called rolling conformity, which just means anytime Congress enacts something, the state automatically follows it. Minnesota is not one of those states. They're a state that we call static conformity, so as of today, they follow the code as of the end of 2016. So none of the things that were enacted for 2017 do they follow as of today, because of course, the legislature has not met yet to decide what they want to do. Thankfully, do the entire slide. There are only a couple of federal tax reform provisions that affect 2017, bonus depreciation, which we'll talk about later, and this toll charge, which is an international tax concept that affects 2017. If we don't see a tax bill before the returns are due in March and April, there's going to be a lot of complexity for taxpayers. The legislature is aware of this, so it's important to stay tuned to see what the state will do. But the simple fact of the matter is this is going to be an enormous deal for the legislature this year. Anytime there's significant change federally, there's a lot of discussion among the states, and particularly this year in Minnesota, because it's an election year, the governorship is up, the House is up, there's a lot of dollars at stake, a lot of companies are very excited about this, and state may take a look at doing wholesale tax reform. They may just say, we're tired of being subject to these changes that the federal government is doing. We want to make a break with this. All I would say is, because of the amount at stake here, now is the time for businesses to speak up. So as we go through our session today, one of our key goals is to make sure you're aware of the key points, the pressure points, if you will, the things that you might want to influence as you reach out to companies who can influence this, speak to the chambers, speak to lobbyists, other people in influence to speak up about what your priorities are.
Let's take a look at tax reduction, which definitely was achieved through tax reform, starting with the individual tax brackets. All the brackets individually have been reduced, including the top bracket dropping to 37% from the prior 39.6%.
Yeah.
And it also begins at a higher taxable income amount. If we look at corporate tax rates, C Corps are the big winners with a drop from 35% to a flat 21%, which the biggest corps were at the flat 35%. But on the flip side, for those C corporations that typically manage their taxable income to $50,000 or less for the year, they're going to see a 6% increase in their tax rate from the 15% that they were paying now up to this flat 21%. And if you're a fiscal year C corporation, you do not need to jump through any hoops to change your tax year to take advantage of the new rates effective for the years beginning after December 31 of 17. Instead, the new law provides for a blended rate for the month before and after the 12/31/17 cutoff. And C Corps have another positive. Alternative minimum tax, or AMT as we commonly call it, has been repealed for C corporations. The goal and the hope was that AMT would be repealed for individuals as well. However, that was not achieved. And this is another way that C Corps are looking like the winners in the new law. What about the credits if you were a C corporation that you might have built up from paying alternative minimum tax in the past few years? Well, there's more good news there. AMT credits are refundable, meaning that even if you don't have C Corp tax liability, you can still get a refund of the AMT credits. And as our slide illustrates, all the AMT credits will be fully used or refunded no later than 2021. I would pause and say there are lots and lots of factors to consider if you're an S corporation and you're wondering, should I revoke my S status and become a C corporation? The significant drop in C Corp rates definitely begs the question and deserves serious consideration as you consider with your tax advisor over the coming months and year on S versus C status and which looks the best. Let's also take a look at the capital gains rates. They have remained basically the same under tax reform. As has always been true, C corporations don't have a preferential capital gains rate, and for individuals, the great news is that the 0% for those able to take advantage does stay in place. On the flip side, the 3.8% NIT tax, or net investment income tax, remains as well, which creates a 23.8% capital gains dividend rate for those that are in the highest bracket.
And from a Minnesota standpoint, if you recall my comment a while ago about what conformity means, states follow the base, but they don't conform to rates, they don't conform to credits. The bad news, if you will, for Minnesota is that all these rate reductions don't necessarily have any effect in Minnesota. Even if Minnesota decided to conform to the code as of the end of 2017, that would not reduce Minnesota tax rates at all. And that's something that legislators are going to need to consider as they head into the session. Do they want to reduce rates as an offset to this broad base?
And let's dive into the business provisions, starting with bonus depreciation. Bonus depreciation, we got fantastic news all the way around. Under the prior law, we would have been at 40% bonus in 2018, and we would have been down to 0% bonus by 2020. But under tax reform, we have 100% bonus depreciation through 2022. It's going to go through a phase-down process, 2023 through 2026, and then it's scheduled to be gone after 2026. An element of bonus is retroactive. So here's one of those things that will impact 17 returns. If you bought and placed in service after September 27th of 2017, bonus at 100% will apply. The caveat being that this retroactive coverage does not include assets where you had a binding contract in place for the purchase prior to September 27th. And the other huge piece of good news, bonus under tax reform applies to used property, not just new property. Dan, I know bonus on Minnesota has some considerations that we want to look at.
You're right. So you may recall that we mentioned that there were only two major provisions of the Tax Act that affect 2017. Bonus depreciation is one of them. And so you may be asking yourself, wow, I'm getting this nice benefit federally. What will Minnesota do? And I will cover the details, but to cut to the chase, it is business as usual. For those of you who have taken bonus depreciation in the past, you're probably familiar with Minnesota's past practice, which is to say any bonus depreciation that you claim federally, in the year that you place those assets in service and claim that deduction, you're required to add back through an addition modification on the return 80% of that benefit, which gives you kind of a bucket of benefit that they make you amortize over the next 5 years. So they do give you the bonus, they just slow it down. Minnesota is doing the exact same thing for 2017, and I've placed the numbers of the forms here that you'll need to use to compute these amounts. For corporations at the bottom, it's on form M4I, which is just their income calculation, and they essentially just say, attach a spreadsheet that shows how you did the conversion from 100% to 50%. For individuals, it's a little bit more complicated. So for those of you who are pass-through entities and are expecting to get these amounts on a K-1, you should be advised that Minnesota did not build the K-1 in a way that automatically calculates those numbers. So you're going to have to do a little spreadsheeting. So for the amount of actual 50% that you took during the year, it's business as usual. So those amounts placed in service 9/27/17 and before, you're familiar with the provision. For the 100% bonus, they actually say, figure out those 100% bonus amounts, figure out the amount that exceeded 50% of your basis, and that's disallowed, and you have to compute regular maker's depreciation on that. Are you confused yet? I can encourage you to take a look at the form, but that's essentially what Minnesota is doing. You convert the 100% down to a 50% and then do business as usual, which is their 80% add back.
Similar to bonus on the federal side, there is great news regarding Section 179 expense election, that election where you can completely write off capital equipment purchases. Section 179 has been expanded to $1 million deduction, but it does phase out if your total asset purchases exceed $2.5 million during the year. It's also been expanded to include roofs, HVACs, and fire alarm security systems. So why would you choose bonus versus 179 now that we have 100% write-off options on both of those? A couple of thoughts on that. If you place significant assets in service during the year, you may exceed that $2.5 million total threshold for Section 179. States also have different ways of handling bonus in Section 179. And bonus does allow you to realize a net operating loss for the year, whereas Section 179 stops your income at break even, and any excess 179 would be carried forward and used in future years. And here is one planning tip that could impact 17 that definitely is worth consideration. If you have buildings, leasehold improvements, 39 long life assets on your depreciation schedule, you may want to expand your 2017 tax return deadline and have a cost segregation study completed to determine if there are any costs that can be segregated from the building life and depreciated over a much shorter period of time. Cost studies have been around for a long time, and they are definitely a way to potentially create significant acceleration of depreciation deductions, resulting in time value of money as the benefit. But in 2017, it's a different game. This is a year where the impact is creating a permanent change rather than just the time value of money from that accelerated depreciation. Under tax reform, the additional depreciation you're taking in 17 is obviously more valuable at the higher 2017 tax rates than it will be under the reduced tax rates starting in 2018. For example, if you're a C corporation and you can accelerate depreciation onto your 17 tax return, you're going to get that deduction at a 35% rate as opposed to your new 28% C Corp rate starting in 2018. So this is one of those areas where you want to talk to your tax advisor if you've got fixed assets on your schedule of the 39-year life buildings, leaseholds, other long-term life that you're currently depreciation. You may end up with a great advantage by extending your 17 return and looking at a cost segregation study.
From a Minnesota standpoint, just to recap, the Section 179 increased benefit is a 2018 issue, so it won't affect the 17 returns that you're filing. We are starting to hear a lot of interest from the business community and focus on this particular provision, what the legislature decides to do. And what I'm hearing from the business community is, when you talk to very large companies, do they have a particular desire to conform to full bonus or conform to full 179? They're kind of more indifferent to it because for their size, it's just a timing difference. It's not as significant a priority as some other things. But when I hear from smaller businesses, Section 179 full conformity is a big priority for them. Just these amounts, they're not as significant for a very large publicly traded multinational, but for smaller, closely held businesses, this is a significant benefit, and their perspective is full conformity makes taxes go way up. There's a lot of room in the budget, in Minnesota's budget, to conform to some of these beneficial provisions, and that may very well be something that the people here attending this morning's presentation may be interested in.
Let's take a look at the business interest expense limitations that have come into play with tax reform. And my reaction when I look at the business interest expense limitations under tax reform, this is one where you say, ouch. We historically, in our businesses, have been able to deduct in full all of our business interest expense that we've incurred. But under tax reform, we are faced with a limit that basically says you can deduct as much interest expense as you have interest income plus 30% of an adjusted taxable income number. Now, the good news is that any excess where you are limited on how much interest expense you will be able to take on your 2018 and forward returns can be carried forward indefinitely. And a great piece of news is if your business has average annual gross receipts of $25 million or less, and that topic's going to come up here in a few minutes too, there are some advantages, and this is one of those, that you will be exempt from this business interest expense limitation.
From a Minnesota standpoint, you may be wondering, would Minnesota conform to this? Should they conform to this? If they simply conform to the new code, they will conform to this. As to what that would look like is a little bit academic at this point, but what I'm hearing is the reason that Congress enacted this, at least in theory, is an offset to the increased bonus depreciation, because the theory was, if we're letting you immediately expense the cost of all these capital acquisitions, we shouldn't also let you deduct all the interest on the loans that you use to get the cash to buy all that equipment. And so the theory is that they kind of go hand in hand. So from a Minnesota standpoint, legislatures might say, well, if we don't fully conform to bonus, do we have as much of an incentive to conform to this interest expense limitation? And then if they decide to do it, they're faced with a new state tax attribute. So like you would have one federally, you have this maybe a disallowed excess business interest expense deduction that's carried forward. The state would need to create one, and then they would say, is that too complicated for people to comply with? Is this really worth all the hassle? Stay tuned, but that's part of what the legislature is going to have to consider as they head into session.
And then especially for manufacturers, the production deduction, which is Code Section 199, has been completely repealed in the 2018 and going forward tax law. Manufacturers have enjoyed this deduction for the past many years, and starting in 18, it is eliminated. It started, 3, 6, and now the last several years has been 9% of qualifying production income. So many manufacturers, this was basically looking at their taxable income for the year and getting a 9% deduction that, starting in 18, is eliminated. But at least for the manufacturers, the Section 199 production deduction has been lost. And if you're a flow-through business, we now have what's called the Section 199A, 20% flow-through deduction for qualified business income. We'll talk about this more in detail in a few minutes, but again, for many manufacturers, you've lost the 9% production deduction, but potentially you've gained a 20% qualified business income deduction, or a net gain of 11% for qualifying business income deductions. So before we get into the detail around this 20% qualified business income deduction for flow-throughs, let's wrap up and spin through a few more items related to business returns. Tax reform has definitely tightened the allowed deduction for meals, for entertainment, and for transportation fringe benefits. No deduction is going to be allowed for activities generally considered to be entertainment or recreation. For example, tickets that you buy to take clients to a sporting event or a concert or the theater. Meals that are provided to your employers and to your employees on your premises for the convenience of you, the employer, are no longer 100% deductible, and those have now become 50% deductible. However, things like your company-wide holiday party or your summer picnic, other occasional events for the benefit of all your employees do remain 100% deductible. Transportation passes and parking fringe benefits are no longer deductible under tax reform. So this is one where if you start including it in the W-2 compensation of your employee, you'd be able to take the deduction, but otherwise it is no longer deductible. The good news on this topic is that meals that are consumed for work travel do remain at 50% deductible. There is no change for meals consumed during work travel from any prior handling. We also have changes related to the net operating losses in C Corps, or the NOLs, as we often call them. Tax reform has changed the time frame for recognizing those net operating losses in your C corporations. Up through 2017, the NOL was carried back 2 years, or could be carried back 2 years and forward 20 years. And 100% of that net operating loss could be used to offset your current income for regular tax purposes. And up through 17, only 90% of the alternative minimum tax loss could be offset with your AMT net operating loss. But under tax reform, there is no more carryback. The carryback has been totally repealed. However, the carry forward is an indefinite carry forward. It doesn't stop at 20 years. And then your net operating losses generated in 2018 and future years will only be allowed to offset 80% of your current year income. This is a game changer. This reduction, only offsetting 80%, is going to impact your estimated tax planning in future years, just to make sure that you stay out of underpayment penalties on if you are in that category where you're only able to offset 80% and are going to end up with 20% regular taxable income.
From a Minnesota standpoint, everyone on the webcast is maybe used to me saying this. This doesn't necessarily have any effect on Minnesota. A little bit of background about why that is. For C corporations, Minnesota has historically not conformed to the federal net operating loss deduction. And the way that they've done that mechanically is when you start the calculation of your Minnesota income, they start with the line on the federal form that is before the federal deduction. And the way that they've computed the Minnesota net operating loss is you only have one if you have a federal loss during the year. You multiply it times your apportionment percentage, and there's a state-only loss attribute. Minnesota they do not currently allow carrybacks, and they wouldn't necessarily conform to this 80% limitation. So the bottom line is Minnesota will not necessarily conform to any of this, even if they choose to follow the federal code as of the end of 2017, unless they were to decide to change their state laws to look more like the new federal laws provisions.
We've got 3 pieces of great news regarding accounting methods allowed under tax reform. If your business has average annual gross receipts under $25 million, and what does that mean? That means you look at the 3 prior years, and if your gross receipts in that 3-year period average under $25 million, then you can elect to use the cash method of accounting rather than the accrual method, which potentially allows your business to more closely match your cash flow and your tax obligations. If you're under this $25 million average gross receipts, you're no longer required to recognize your tax inventory under the UNICAP inventory rules. And on that, that potentially allows you to directly write off more of your indirect costs rather than capitalizing them to inventory. And if you're under that $25 million average annual gross receipts, you can elect to recognize revenue from long-term contracts at completion rather than having to use the percentage of completion method to recognize that revenue. So these are 3 accounting method changes for businesses that are under this $25 million gross receipts, and they're going to receive automatic consent from the IRS. The reduction in taxable income in this first year of change would be recognized in full as a deduction. And so if your business falls under that gross receipts test, taking a look at these changes is definitely worth considering, discussing with your tax advisor, and see if you should make a switch. Let's take a quick look at business credits that have been retained or modified, and in one case repealed under tax reform. So several of the credits were retained, and I'm going to focus on a couple. The research and development credit, fantastic credit for manufacturers as well as many other businesses. And also the work opportunity tax credit was retained. In earlier versions of the tax bill, the work opportunity credit was scheduled to be completely eliminated. But in the final version, it was retained, and it does allow companies to hire veterans and also other specifically targeted groups to end up with a really nice tax credit on your business return. The work opportunity tax credit is creating about $1 billion in U.S. tax credits each year. So it is definitely a credit worth considering that did stay in the tax reform bill. If you're not currently taking advantage of this, I would strongly recommend that you take a look and see if some of your hires would qualify for the work opportunity tax credit. We do have one new credit this year under tax reform, the employer paid family and medical leave. This is a credit that's only available in 2018 and 2019. Let's consider some of the international changes. Tax reform created significant, and I say that with a capital S, changes to international tax law with the intention of making the U.S. more globally competitive. In our 1-hour overview today, we cannot possibly do justice to the international impacts, but we want to talk to at a very high level, and we do also have Jim Loazzo, who heads up our international tax practice here in Minneapolis, that's available for questions that might be raised on this topic, both during the webinar as well as the live Q&A sessions afterwards. So let me just brush through a few of the comments at a high level on international tax, and Jim is available to us for questions. Most businesses with foreign subsidiaries are going to be required to pay tax starting with their 2017 tax return. So again, this is an impact on returns that are being prepared and filed now. And that tax is going to be on the undistributed earnings as of December 31st of 2017 that is sitting in your foreign countries and that has not yet been taxed by the United States. The good news on this topic is that the business is going to be allowed to spread payment of that tax over an 8-year period. The first eighth of that is going to be due with the filing of the 17 return, and then we have the next 7 years to finish paying that tax. The second piece of good news on this international topic, the U.S. tax rate on those undistributed earnings is even lower than the regular C corporation rates. The rates are 15.5% for cash that's sitting on the balance sheet of those foreign subs, and it's only 8% for all other assets. That's the C Corp look at it, and similar low rates exist for flow-through business owners as well. Owners of S corporations, and this applies to S corporations only, are allowed to defer recognition and payment of this tax until what's called a triggering event. And speaking very generally here, that's basically at the end of the S corporation entity. And on a go-forward basis, C corporations, and on this I'm saying C corps only, are going to receive a 100% dividend received deduction for distributions received from their foreign subsidiaries. So C corporations under tax reform are no longer going to be under the pressure to leave earnings outside the United States in order to delay their taxation. That's all I'm going to say about international tax, and I'm only brushing the surface of this broad international tax change under reform. It is crucial that you remain in conversation with your tax advisor to ensure compliance if your business operates internationally. And again, Jim Loazzo is available to us for questions that might be raised during this webinar, as well as the live Q&A afterwards. Now, Dan, since this impacts the federal 2017 returns, what is Minnesota's stance on this international topic?
Oh, that is a wonderful question, Virginia. So what I've just learned actually this morning is I believe the Minnesota House is planning to circulate a draft of their federal conformity bill tomorrow. So we should have at least more of an inkling of what the legislature is planning to do. The only thing that we know as of today is what the state is planning to do, kind of, with respect to this 27 tax change, has to do with the forecast that was in that link that you'll see on the earlier slide about their scoring about what federal full conformity would be. And admittedly, the people that drafted the report said that Minnesota's ability to tax this is unclear, and so they just assumed that it would be taxable as a dividend in Minnesota and would be eligible for a 20% dividends received deduction. So that's how they revenue scored it. But if you remember back to the very beginning of this presentation when I said, what does federal conformity mean? The state conforms to the base. They don't conform to the rates or credits. And so when you think about what full conformity would mean for a state like Minnesota, it would mean that big, the toll charge, the deemed dividend, they would conform to that, but they wouldn't necessarily conform to the favorable rate payment schedule that the federal government is offering to pay that amount over 8 years. States aren't automatically going to follow it. They won't do that unless they choose to do it. There is also the additional question of, do states constitutionally have the right to tax this type of foreign income? When you consider the sheer size of these amounts, you can guarantee there's going to be a lot of controversy, probably a lot of litigation. This is going to be an enormous issue for the business community, and all I can say is stay tuned, but hopefully we'll see a little bit more in terms of this draft bill from the House that we expect to come out tomorrow.
Okay, before we shift gears and spend some time looking at the 20% flow-through business deduction and a few other shareholder impacts, let's take a quick look at the summary of some of the business planning considerations that we've discussed so far this morning. In summary, we talked about the cost-seg study, and this is where in 2017, you can take advantage of a permanent tax rate difference in addition to the time value of money from accelerating that depreciation. We've talked about the importance under the new law to take a look at your S status and determine, should I remain an S or does it make more sense to switch to a C? We talked about the accounting method changes, especially if you're in that 3-year average of 25 million or less of gross receipts, the ability to switch to the cash method from accrual to go on the completed contract method rather than percentage of completion. And we talked about UNICAP as well, that will not apply. And from international viewpoint, again, a huge part of this law, you may want to consider earnings and profits study to make sure the amount of tax that you're paying, starting with your 17 tax return, in fact, is the accurate amount of tax that you owe. And going forward, transfer pricing studies, consideration of your ICDIS and other international issues will become of great importance. Let's shift gears and take a look especially at the new 20% deduction for flow-through businesses. Under tax reform, we are allowed a 20% deduction for qualified business income, and this is called the 199A deduction. This is an extremely important topic, but I think the most important part of this message today is stay tuned. We need clarification. We need an expansion of definition. We need technical correction on many of the details inside this area of the new law dealing with this 20% flow-through business deduction. Let me just cite one that's of special concern to a fiscal year S corporation. At this point in time, it is not clear how fiscal year S corporations will be handled for 2018. The law says that the deduction, the 20% flow-through business deduction, applies to tax years starting after December 31st of 2017. So if you're a fiscal year S corp and your business year started October, November, or December 1 of 2017, what does that mean for you? The letter of the law would say you will not be allowed in 18 to take the flow-through 20% business deduction. But stay tuned because regulations and clarifications are anticipated to become known in the weeks and months ahead. This is a high priority area because roughly 95% of business in America is privately owned or flows through to the shareholders. And so there are many people standing, waiting to see what the exact definition and treatment of this flow-through deduction is. If you're a C Corp business, your benefit under tax reform is pretty clear. No matter what type of business you have, you're going to have a flat 21% tax rate on your income. On the other hand, if you own a flow-through business, there's lots of confusion, again, around who qualifies for this 20% deduction. So let's talk through a few of the things that we do know about the 20% deduction, which, through its intent, was considered to level the playing field for flow-through businesses in line with the fact that the C Corps get this greatly reduced 21% rate. So what facts do we know so far about the 20% deduction? It starts in 2018, and it's scheduled to end in 2025. The C Corp rate, on the other hand, is a flat 21% that starts in 2018, but it is a permanent drop in rates with no scheduled ending date. And then what types of entities qualify for this 20% deduction? Basically, any flow-through entity, including a sole proprietor that reports on a Schedule C in their personal tax return, S-Corp owners, partners in partnerships, or members in LLCs, and even trusts qualify for the 20% deduction. What types of businesses actually qualify for this 20% deduction? The language is most trades or businesses qualify except for certain specified service businesses, and those do not qualify. Some under that category of specified service businesses that don't qualify include law firms, accounting firms, consulting businesses, investment firms, etc. Now, engineers and architects are on the list of those that do qualify for the 20% deduction. But the message again here is stay tuned. We will be receiving more clarification and regulations on exactly who does and who does not receive this 20% flow-through business deduction. And do I get, okay, on the topic, do I get a 20% flow-through business deduction? And the answer to that is maybe. If your married filing joint personal taxable income is under $315,000, so when you file your personal return and you've got taxable income of under $315,000, you can basically deduct 20% of income, including even the income earned in one of these disallowed special service businesses such as a consulting business or a law firm. If your income is higher than the allowed thresholds for taxable income, your qualifying business deduction is going to be further limited to the greater of 50% of the wages from that business, or, and they threw this in for those businesses who do not have significant wages, or you can look at the greater of 25% of your business wages plus 2.5% of your cost basis in allowed depreciable assets. So again, this topic, we want to stay tuned for regulations, potentially technical corrections and clarifications on this 20% deduction allowed to flow through business. And as I mentioned before, the good news is about 95% of U.S. companies are passed through and taxed at the shareholder return. So that 95% of the business community across the United States is looking for answers on how this is going to shake out. So clarification is an extremely high priority on taking this 20% Dan, would you update us on what the deduction means for Minnesota?
I would be glad to. So I'll just cut to the chase on this slide. There are a lot of bullets on this slide, but the synopsis of what it means is Minnesota is one of 6 states that has to do their homework maybe a little harder than other states about whether they want to follow this. And the reason is, for federal income tax purposes, this 109 Cap A deduction is what we call a below-the-line deduction. It's a deduction that affects taxable income, but not adjusted gross income. And when a lot of states are defining how do they want to build their state individual income tax, they start with adjusted gross. Minnesota wants to be different. They're one of 6 states that follows taxable income, which means if the only thing the legislature does is they roll forward their conformity to the Internal Revenue Code at the end of 2017, they have to follow this, unless they decide not to. So they can't just do business as usual, roll forward the code, and expect everything to work well. They really have to think hard about whether this is a good idea for them to conform. Well, I am hearing a lot of interest from the business community about conformity to this, and the message that I hear is, again, from the department's own revenue scoring of this, full conformity to everything in the new tax act would make taxable income go way up. And so the message is there's a lot of room for conformity to some of the more favorable things, such as this small business deduction. And again, stay tuned. Hopefully we'll be able to get the House's draft conformity bill tomorrow, and hopefully they'll address something like this. But what I've been hearing is this is a pretty significant initiative that people would like to conform to.
Let's take a few minutes and look at individual tax deductions. We'll spin through this fairly quickly and then focus again on some of our Minnesota impact from this. Standard deduction has been doubled for the most part. Personal exemptions have been completely repealed. Mortgage interest has dropped down to allowed debt of $750 from our prior $1 million, and home equity interest basically disallowed unless it's used for acquisition of the residence. The really big one here in the state of Minnesota is that taxes, which includes the aggregate of property tax plus your state income tax, will be limited starting in 2018 to a $10,000 deduction. For all of us with flow-through businesses, this is a very significant reduction in our allowed deductions. Charitable contributions, basically the same, increase the cash limit to 60% of your AGI, and are repealing the deduction for athletic ticket rights, previously classified as a charitable deduction. Miscellaneous itemized deductions in 18 are completely repealed. In medical expenses, we do have a retroactive consideration here where the 7.5% floor will apply to 17 as well as 18 going forward. But I think the most important piece of this is really, for those of us here in Minnesota, what does this mean when we look at our Minnesota returns?
That's a great question, Virginia. And as you can see on this slide, what I've essentially done at the bottom is I've recapped the department's own revenue scoring of all of this. So back to the comment that we had, federally, the new tax bill broadened the base and lowered the rate. And so if you look to the bottom, yes, the standard deduction went up, and so Minnesota would automatically conform to that, which would be a revenue loss. But for Minnesota, that is far more than offset by the elimination of personal exemptions and the limitations on itemized deductions. This would be a big revenue raiser for the state. And if all they do is conform to the code as of the end of 2017, this is what will happen for Minnesota. So again, it'll be very eye-opening to see what the state does. Will they just accept this big windfall, decide to spend it all? Will they pay down rates? It remains to be seen. But this is what's happening if all they do is business as usual and conform to the code. I did want to spend a little bit of time talking about the federal government's limitation for individuals of the deduction for state and local taxes, which is sales tax, property tax, income tax, everything. The bottom line of this is that if you live in a high tax state like Minnesota, taxpayers now bear the full economic cost of that tax. You can't just say, oh, the Minnesota rate is 9.85, but the economic cost of that is really that minus the federal rate. It's a lot harder to do that. And for those of you who've been watching this in the paper across the country, this is probably the most kind of high profile issue that's been catching a lot of attention in the media. So what I've done is I've listed here about what some other, relatively high tax states have proposed. Some of them, you might put a little smile on your face. For example, California, there's serious consideration about a bill that would say, we're going to create the California Excellence Fund. And if you make a charitable contribution to that, then we'll credit that against your state taxes. So the idea would be you would pay your state individual income taxes up to 10 grand. Everything above that you would pay as a generous charitable contribution to the state, which of course has no deductibility limitations federally. And as you've read in the press, the IRS has kind of a bullseye on that. Questionable whether that would survive scrutiny by the IRS. Other states like New York are considering increasing payroll taxes on workers, on businesses, and of course the result would be there would be a reduced W-2 paycheck to the employees with a trust us, the math works out. This is the economic equivalent of this. You had the same paycheck as before, but you're allowed to have a full deductibility of your state taxes. Might be harder to sell to explain to workers what that is. The most recent proposal, different one from those that has been proposed, is from Connecticut. And they would say, and this is the governor had this in his most recent budget bill, that they would have a tax on all pass-through entities and income tax at the entity level. And then what they would do is they would essentially take those taxes that they collect, turn around, and they would credit it to the business owners on their individual income tax. So it's maybe a little bit simpler to explain. There are states out there that have income taxes on pass-through entities. And as long as you can make the math work, it would actually be a revenue neutral tax for the state that would restore the federal deductibility of these taxes. So I've gotten a lot of interest when I've come to meetings such as with the Chamber, with the CPA Society, others. This is a big issue for taxpayers. Minnesota is a high rate state. They're saying, what are the options that we can have to restore the full federal deductibility of Minnesota's higher rate? And they listed a couple items that have been discussed. One of them is some people acknowledge that there are other states that say if you are an S corporation federally, you can make a state-only election to be taxed as a C corp. For example, our neighbor to the east, Wisconsin, has done this for many years. And they would say, is that something that we can consider as a state to say if you're an S corp in Minnesota, you can check the box or file some form and be a C corp for state. And what that would do is that would, instead of having you pay individual income tax on your distributive share of S corp earnings, which now you're subject to this federal cap of 10 grand, you'd shift that same cost to the business. Businesses don't have this cap. The economic cost, it's the same. You would eliminate the cap. Would that work? And I think as we push the pencil for Minnesota residents, that would be a bad answer because what our neighbor to the east, Wisconsin, does, they say if you're a C corp, you're a C corp for all purposes, including the beloved double tax that we know and love for C corps. And so they would say we now impute a dividend for shareholders of this kind of make-believe state-only C corp. If you do that, your state taxes just went up. This isn't revenue neutral, and that increase on individual income taxes of these kind of state-only C corps might wipe out the federal benefit of doing that. So that might be a non-starter. And so what the state may be giving some serious consideration to pursuing the Connecticut approach, which is having an unincorporated business tax. So it would be sole proprietors, partnerships, LLCs. Wouldn't extend to S corps, unfortunately, but it might move the needle on those. What it doesn't address is just high net worth, high revenue individuals like corporate executives. You're getting a W-2. This mechanism wouldn't help you. And so the question that Minnesota needs to wrestle with is, does this help enough? Is it simple enough that they could actually implement it, keep track of it? My personal thought is it isn't as far-fetched as maybe like this charitable contribution thing. It might actually withstand federal scrutiny, and if it can be done simply, it might be something that would be beneficial. So if you are interested in this particular topic, this might be something to consider as you speak to those that can advocate to the legislature for these types of provisions.
As we come close to the end of our time, the last slide does deal with some other individual provisions that have been retained in the law. And the one I'll just highlight is the individual alternative minimum tax. There was talk that it was going to go away. It has been retained for individuals in tax reform law. It did go away completely for C corporations. However, the exemptions have been increased, and so less persons will incur alternative minimum tax, most probably, but stay tuned in your own fact pattern.
Thank you, Virginia, Dan, and participants. We covered a lot of great information. Please submit your questions via the question function located on the right-hand side of your screen, if you have any questions for our presenters. I'll pause right now to see if we have any direct questions. And again, if we're not able to get to them, we will make sure to have a CLA professional reach back out to you. We'll wait a couple minutes here, or a minute. Okay, at this time, there are no questions that I'm seeing come across, but feel free to send them at any point in time. We will begin our Q&A session at the viewing locations. And I will also put up the contact information for the presenters today. Watch for an email next week containing a link to the webinar recording and presentation slides. Thank you so much for your participation today, and thank you again to the Minnesota Chamber and Manufacturing Coalition. Have a great day.